Hello, everyone. I'm Mark Malek, founder of Wall Street Truthbombs and CIO at Siebert Financial. This quick recap is sponsored by Siebert Financial, where investing is for everyone. Now, let's break down the big themes that drove the markets this week, and more importantly, what they mean for your money. This was a week that put every market thesis under pressure at the same time. A single corporate announcement triggered a $290 billion wipeout in global chip stocks in one single session. A jobs report came in at less than half of what Wall Street expected, and falling energy prices quietly rewrote the inflation calculus for central banks on both sides of the Atlantic. By the end of the week, markets had largely recovered, but the questions this week raised are simply not going to go away so fast. The dominant story of the week was the sudden and severe sell-off in AI-linked chip stocks. On Thursday, the Korean Kospi plunged nearly 8% in a single session. SK Hynix shed approximately 15%, and Samsung fell approximately 9%. A combined $290 billion market value erased in one single day. This happened after Meta Platforms announced plans to sell excess computing power. It raised immediate questions about whether AI capacity is running ahead of real demand. That fear cascaded directly into U.S. markets, dragging down the NASDAQ by 3% and sending Micron, no surprise, and SanDisk each down more than 10%. The rout proved short-lived. By Friday, SK Hynix and Samsung had each rebounded more than 8%. Asian shares rallied more than 2%, and NASDAQ 100 futures recovered alongside of them. As you know, cash markets here in the U.S. were closed on Friday in celebration of Independence Day. What the week revealed is the fragility built into a market where tech now accounts for 39% of the S&P 500. AI funds were the standout performers of the entire second quarter, with the average technology fund gaining 40% in Q2. That concentration cuts both ways, though, and Thursday's session was a stark reminder of how fast it can. Before we go on, if you like this type of content, please click like and don't forget to subscribe. It's important to be in the know, and this is how you do it. Okay, the second major theme came from Thursday's June jobs report. Non-farm payrolls came in at just 57,000. That was sharply below the 113,000 consensus estimate and well off the prior month's reading, which was itself revised down from 172K to 129,000. The 2-month net revision came to negative 74,000 jobs. Private payrolls told an even softer story, coming in at only 49,000 against a prior revised figure of 97,000. Markets didn't wait for analysis. The dollar fell to a 2-week low. Gold rallied toward $4,200 an ounce for its first weekly gain since May. And emerging market currencies broadly strengthened as traders scaled back bets on further Federal Reserve rate hikes. Fed Chair Kevin Warsh struck a more measured tone at the ECB's Sintra Forum, though Cleveland Fed President Hammack maintained earlier in the week that further hikes may still be needed if inflation stays elevated. That divide within the Fed kept the long end of the yield curve from fully embracing the dovish pivot, and it sets up a very critical week ahead. Now, the third theme was the quietest, but arguably the most consequential for the medium term. Oil prices continued to retreat toward pre-war levels following the interim U.S.-Iran accord that reopened the Strait of Hormuz. That energy normalization had direct consequences for inflation prints. Eurozone CPI fell by more than expected in June, aided by lower energy costs, no surprise there, putting the ECB in what one governing council member described as a good position. We've heard that before. ECB officials at Sintra, including chief economist Philip Lane, stopped short of committing to further hikes while stressing vigilance on second-round inflation effects. The energy-driven risk-on tone showed up directly in European equities. The stocks Europe 600 broke out to a fresh all-time high, rising 2.7% for its best weekly performance since May. All three themes connect into one larger story. The AI trade is powerful but concentrated and very vulnerable to single headline shocks. The macro backdrop is shifting as energy prices fall and labor markets cool, and central banks on both sides of the Atlantic are navigating the aftermath of a geopolitical energy shock with genuine uncertainty. The Fed is split, the ECB may be done, and markets are repricing that divergence in real time. Investing in your future doesn't have to feel intimidating. At Siebert, you're never on this journey alone. Our team of advisors, brokers, investment managers, and insurance professionals is with you every step of the way. We believe your financial plan should be as unique as you are, not a one-size-fits-all template. As a leading brokerage and financial services firm, we tailor our solutions to your goals, your timeline, and the life you're building. If you're ready to take the next step toward true financial freedom, visit Siebert.com to learn more. Looking ahead, the week of July 7th through 10th brings three distinct tests for markets, and they are all very much connected. First, the FOMC releases minutes from its June 17th meeting, the first under Fed Chair Kevin Warsh, and markets will parse every single word for signals on whether a rate hike remains live for July after Thursday's weak payroll print. ECB minutes are also due, arriving at a moment of unusual internal division. Just 3 weeks after a unanimous hike, governing council members are openly split on whether another move is warranted this year. Second, a NATO summit in Turkey and an OPEC Plus ministerial meeting on crude production policy return geopolitics to the center stage. With oil prices having already retreated to pre-war levels, any supply response from OPEC Plus could reignite the very energy price pressures that markets just started to price out. And third, Q2 earnings season kicks off, and given that a single Meta announcement about compute capacity was enough to wipe $290 billion from global chip stocks in one session, any guidance that calls into question the pace of AI infrastructure build-out is likely to generate sharp cross-asset moves. The week is effectively a three-way test of central bank credibility, geopolitical stability, and of course, the durability of the AI trade. All three are interconnected, and all three will be in play at once. And your truth bomb. The media spent all week debating whether the AI trade is broken, but the real question is simpler and more unsettling. When tech is 39% of the S&P 500 and a single Meta headline can wipe $290 billion from global chip stocks in one single session, every investor in an index fund is already an involuntary tech bull, and most of them don't even know it. So here's the bottom line this week. The AI trade showed its volatility, but not its end. The jobs report has meaningfully repriced the Fed's rate path and given rate sensitivity assets a bid. And falling energy prices are doing what rate hikes alone simply could not, cooling inflation at the source. The week ahead will be a test whether the Friday recovery has legs or whether central bank minutes, geopolitical events, and earnings season land all at once and force markets to choose a direction. I'm Mark Malek, and this has been your weekly market themes recap, sponsored by Siebert Financial, where investing is for everyone. Join me every day at Wall Street Truthbombs, where I drop them right here before the market figures them out.